Hey, what's up? What's up? Good afternoon, everyone. Welcome to today's webinar. I am Olatunji Michael, and I'll be taking you through today's webinar. And first and foremost, I want to use this time to thank every one of you who has taken the time to send us feedback. I haven't watched a couple of our webinars. We want to say a big thank you to you, and we wish to give you even more value. And as long as you keep giving us feedbacks on our videos and asking us questions when necessary, we would always want to give you the best. We always want to offer you the best of value as we can. Alright, thank you so much. We really appreciate you. Today we'll be talking about market structure. Okay, structure is a basic component of when it comes to arrangement of things. Alright, so when we talk about structure, you could relate it to a whole lot of things. In the engineering sector, you could look at it in form of probably a structural engineering aspect. You know, everything has to be arranged in an organized manner. All right, so structure is simply a predefined way something is being arranged. Okay, it's a systematic manner. All right, and it should go by rules. All right, so let's take this bridge for an example. You can see we have a structure here used as a bridge, and components of the structure that are way obvious are these bars. You can see they are calculated, they are accurate, and they are systematic. All right, so just one part of it can disable or will affect the whole system itself. All right, so the forex market itself has a structure. Alright, we have this psychology, and it's way a fact that the market does not always move in a straight line. It moves in a zigzag manner. Alright, so but in those zigzag manner, there's how we can identify structures in between. Alright, so basically we'll be starting with structure, and at some point, if this goes over your head, please find a way of playing this video over and over again so that you can grab the context. And if you don't, please just drop a comment below with your questions. We'll answer them in subsequent videos. Alright, so we'll be talking about types of market structure. We have the bullish market structure, and we have the bearish market structure and the consolidating market structure. Alright, so a bullish market structure just comprises of a rising market. Alright, it's separate series of impulsive move to the upward direction. So any market that moves to the upward direction or is ascending, we can call it a bullish market. Okay, and the inverse will be for the bearish market structure. So it's a structure that comprises of falling markets, which also has a series of impulsive moves to the downward direction. So when a market is falling or it's losing value, we can say it's the bearish market system or structure rather. And we have the consolidating market structure. Now this is a market structure that is neither rising nor falling. All right, it's just in between, or it could just, it's ranging, it's haphazard. All right, so that is a consolidating market structure. And so we'll be looking into these market structures, especially the bullish and the bearish market structure. We'll be looking at how we can identify and how we can know its rudiments. Alright, so this is a simple market structure for the bullish and the bearish market structure. Now you look carefully, we have A to B, B to C, and C to D. Alright, so this is an ABCD movement. Like we said, the market does not always move in a straight line. Alright, they will have some break, some retracement, some reversals or something. So I want to look into how do we get to identify which is impulsive or corrective. All right, So in this form, we can name them in form of waves, which we have here as impulsive and corrective waves. So we can say A to B to be an impulsive wave, B to C a corrective wave, C to D an impulsive wave. All right, so obviously we can see that A to B is longer than B to C. All right, so we can conclude that a corrective wave is always shorter than an impulsive wave. Okay, so we're going to name that as a fact. All right, impulse waves are longer than corrective waves. Okay, so after an impulsive wave, we anticipate a corrective wave. All right, because we have the predetermined direction that the market is bullish. So anytime the market is bullish, you always want to see impulsive waves. All right, and a little of corrective wave. So we have an impulsive wave moving from A to B, this is impulsive, B to C a corrective, C to D another impulsive wave. Same thing for the bearish market structure. We have A, B, C, D. All right, the market does not move in a straight line. At some point the market wants to move from A to D, and even though you can at some point determine the direction or the destination of the market, it won't just move in a straight line. It will move in a zigzag manner, in an haphazard manner. Okay, so we have A to B to be an impulsive movement, B to C to be a corrective movement, and C to D another impulsive movement. All right, so you have the fact that impulsive movements are longer than corrective movement. So every time we anticipate a bullish market structure, then we want to see impulsive movement in the upward direction. And if you're anticipating a bearish market structure, they want to see impulsive waves to the downward direction. All right, so that's the difference between the corrective and the impulsive wave. All right, now we'll just be adding a little, which will be including the extension and the retracement. Okay, so we've already made an example of, we talked about what an impulsive wave looks like. So we can replace the corrective wave with a retracement. All right, corrective wave is same thing as saying retracement, is same thing as saying a pullback or an outside return. All right, and for the impulse wave, we're breaking it into two. All right, so if we ascertain that A to B is an impulse, B to C is a corrective wave, then we can say that between C and this B point is also corrective. All right, it is only when it moves over B, okay, it goes above B, that becomes an impulse. So the distance between the B point and the D point will be called an extension. All right, so that's an extension of B. Okay, so it's more like using the human system, we tend to breathe in and breathe out. All right, so it's a systematic logic. It's a system where we have to breathe in to breathe out. We have to breathe out so that we can breathe in. So the market has to breathe in and breathe out in form of corrective wave. So if it breathe in, it breathes out, then it breathes in again, or however you want to put it. But we should understand that there is the difference between a retracement and an extension. All right, so the same thing applies to the bearish market structure. A to B is an impulse, like we said. B to C a correction. Now a correction is also called a retracement. All right, because it was moving in a downward direction, then it's changed course a little. All right, so changing course a little, like the literally mean of retracement means for something to have changed a direction a little. So that's a retracement. All right, so C to D becomes an extension, and why we're naming this an extension is for the fact that it has gone below B point. If it doesn't go below B point, if this D point doesn't go below B, it is not an extension. Hence, we can't call it an impulsive wave. Okay, so that's just the anatomy of the market structure. It's just pure logic. All right, so we can categorize the wave into this pattern. A to B is an impulse. All right, so the corrective wave is A to B greater than B to C. Okay, it's very simple. We are just trying to say A to B is longer than B to C. All right, so for us to call this a corrective, it must be shorter than A to B. Okay, that's the rule. If it goes below A, it is no longer corrective, it becomes an impulse. So corrective, because the C point must not go below A to come weight into this direction, or it might even stop at this level. As long as it does not go below A, it's a corrective wave. So impulsive wave, we have BC less than CD. Alright, that means BC should be shorter than CD. For us to call this an impulse, that means it must be longer than BC. So that means literally we're trying to say that BC must be broken, or CD must come above B before we can call this an impulse. So you should understand the difference between the retracement and the extension. Now, the retracement is BC, which is just that little pullback, and the extension is above CD. So if the market will move from A to D, all right, so this B point will just be a circle of correction, all right. So the extension here gives us the total movement between A and D. All right, so we have this circle as the correction, all right. That's the corrective circle. So this is a market circle for correction, meaning between B and C will give us a corrective wave. Between B and C will give us a corrective wave. Now we want to talk about mini and macro structure, all right. So the mini structure is a smaller structure, while the macro structure is a bigger structure, right? We can say mini or micro, however. So A to B is a macro structure, meaning it is big. It's a big wave, but between this inside of this big wave, which is a macro wave, we can find tiny movement in between. Okay, so we mean A to B is a straight line, and we go literally on the forex chart, you can't see that a straight line, all right. We can still find some form of zigzag movement in between, all right, but we can find that this movement is a micro structure or a mini structure. B to C is a macro structure, while we have the black lines as a micro structure. So we can have smaller structure inside of bigger structure, all right. So it's more like you're trying to slice onion. Okay, we can see structures and structures and structures and structures in between, all right. So that's how it looks like. So we have bigger structures and smaller structures. Same thing applies for the bearish market. We have A, B to B, a macro structure, while we have the tiny black lines as microstructure. Now moving ahead, we're going to differentiate what we mean by the micro and the macro structure. All right, now so we have a random chart here showing the bearish and the bullish market structure. Now we want to identify what do we mean by the market structure and how can we visualize it. Now trading the foreign exchange market, you should be able to train your eyes to see those movements. Now they won't just come naturally. You have to train your eyes to learn to identify them. All right, so where are the macro structures and where are the micro structures? So we'll be starting with the macro structure. All right, so we can see we have A, B, C, D to the downward direction, which is bearish market, and you can see that we have candles moving here, and we have a retracement to the up direction, which is a corrective wave. Then we have a CD, which is an impulsive wave. Same thing applies for the bullish market structure. We have A to B, which is impulsive, B to C, which is corrective, C to D, another impulsive wave. Alright, so we can see that between B and C, we can see that there was a huge movement relatively, and between B and C, we can actually see that there was a correction, and it is obvious. Alright, it's an obvious correction. Now what about the mini or the micro market structure? All right, so this is a micro structure or the mini structure. When we have A to B, in between A to B we can find a zigzag. All right, that's a micro movement. And in between B to C, between B point to C point, we can also find another zigzag, okay, which is another micro structure. And in between C to D, we can find series of zigzags. So like our previous example, we can have micro structure inside of a macro structure. So C to D is a macro structure, while we have this little movement as a micro or mini structure. For the bullish market structure, the same thing applies. We have A to B as a macro structure, but we can have a micro movement in between. We have B to C as a correction, right? Then C to D also as an impulse, but between C to D we have a microstructure in between. So we should be able to identify macro structures and microstructure, but that can always that can only come in play if we learn to identify them. All right, we have to train our eyes to pick out the micro and the macro. Both of them are very important when it comes to analyzing, making analysis, but over time we get to understand all of that and how we can apply them. Next, we'll be talking about structure shift. All right, we believe that, like we said earlier, the market does not always move in a straight line, and sometimes it tends to correct, and sometimes the market reverses directly. Okay, it can reverse from a bullish market to a bearish market. All right, so we can look at different type of structural shift. Firstly, we're talking about break in market structure, which is a BMS. So we have an impulsive move, a corrective move, and an impulsive move. Now we've ascertained that after every impulsive move, we anticipate a corrective move. You can only anticipate because everything deals with probability. All right. But for a market structure to continue, then we have to see an impulsive move tending toward that direction. So if you are having a bullish market structure, we want to see impulsive movement to the upward direction. If you're anticipating a bearish market structure, we want to see impulsive movement to the downward direction. All right, so we having an impulsive move, a corrective move, an impulsive move. Now after this impulsive move, we anticipate a corrective move, but we have an impulsive move here, so that contradicts the normal rudiment of impulse correction. So this can bring about a possible shift in market structure, because over here at this level, denoted by this green arrow, we can see that the market has gone below it. That means it has broken this structure. So that's why we call it the break in market structure. Now it has broken this structure. We've highlighted it with a circle, and this gives us a tendency that there's higher probability that the market will not continue in the upward direction, and there's high tendency it will move towards the direct direction downward, meaning there's high tendency the market will reverse. So after impulsive move, we anticipate a correction. Now for this to be a correction, it must not go above this level. All right, so this is a correction followed by another impulsive move. So that's basically a change in market structure. All right, a shift in market structure, but this time around it came off of a break in structure. So we can say we have impulsive, corrective, impulsive, impulsive. So this having two impulsive has brought about a change in market structure through a break here. All right, same thing applies for the bearish side. We have impulse, correction, impulse. We are anticipating a correction, but we have an impulse. So impulse is a tendency for a shift in market structure. So after this impulse, we anticipate a corrective wave, then another impulse to the upward direction. So in this category, we are moving from a downward direction to an upward direction, and this can be denoted, or this is being highlighted singularly by the view of a break in structure. Right, so when this structure breaks, there's high tendency the higher institutions or buyers, the sellers are no longer interested in moving downwards, and now buyers are taking over the market. So that means they are breaking the stronghold of sellers. Okay, so you can see all these immediate highs are stronghold for sellers. So the market is breaking through those levels. All right, so that's break in market structure. So we should be able to visualize the break in market structure. So we have this as a break in market structure going contrary to the normal rudiment of impulsive, corrective, impulse. Now we talk about shift in market structure denoted by SMS, and this is a potential change in market structure which we can actually see when analyzing or when making analysis. Same thing applies similarly to the break in market structure. We have an impulse. After an impulse, we anticipate a corrective wave followed by an impulse followed by a corrective wave, and after a corrective wave we anticipate an impulse for the market structure to keep moving upward. But now we've seen a truncated wave, meaning the wave have not gone above this level, so we can't call it an impulse. So since it couldn't break this high, it becomes a corrective wave. all right, it becomes a corrective wave. Now that is a shift in market structure. So we could have it as a double top here or slightly below here. That's a shift in market structure. So we have this horizontally and we have this inclined. All right, so if when the market fails to create a new high, is a shift in structure. So there's high tendency that the structure will shift from an upward or a bullish structure to a bearish structure. Now the inverse for the other example, when we have impulse, corrective, impulse and corrective. All right, so the market hasn't made a low, okay, it has not gone below this level, so that makes this level, this wave, a corrective wave. Now remember, not until it breaks this low or go below this low, we can't call it an impulsive movement. So against the normal rudiment, after an impulse we anticipate a what? A correction. After a correction, an impulse. After an impulse, a correction. You know, the basic rudiment. Now if this has failed to make an impulse, so that can bring about a change in market structure. You know, we can anticipate a change in market structure. It is not definite, it is just a tendency, it's a probability that the structure direction might change from a bearish structure to a bullish market structure. Alright, this is another random chart. How can we visualize this structure from a random chart like this? Like I said, we have to train your eyes to identify this thing, and being able to identify them you know, would be a basis for your justification. All right, so looking at this, we're going to see how we can actually pick out those you know, movement and direction. All right, now we have a break and shift in market structure all in one. We're trying to see how we can name them out. All right, so starting from A, we have A to B as an impulse, B to C as a corrective, C to D as an impulse. Now this denotes that the market is moving to the upward direction. Now we have D to E. We have D to E as a correction, and E to F as an impulse. F has gone above D, so it becomes an impulse. Now after F, we are anticipating that we get a correction for the market to keep moving upward. But this time around, we've seen that it has broken through the point of E. Alright, so this gives us a tendency that the market structure may shift. Alright, so this becomes automatically an impulse. Prior to now, we're anticipating a correction, but breaking through this point of E, this becomes automatically an impulse. And after an impulse, we anticipate a correction. Now we can highlight this level broken as a break in market structure. Now after this impulse will give us a correction. Now 1 to 2 will give us a correction, 2 to 3 will give us an impulse, 3 to 4 will give us a correction, 4 to 5 will give us another impulse, 5 to 6 will give us a correction. Now 6 to 7 we ought to have an impulse, but this isn't an impulse because it hasn't go below 0.5. Alright, so this becomes a correction. So that means we have this as a correction, we have this as a correction. Alright, so we have from 7 we have point A. Now point A is an impulse. Why do we call point A an impulse? It's an impulse because it has gone above 0.6. Or say this is an impulse because it has gone above 0.6. So if this is an impulse, we should anticipate a correction followed by another impulse. Okay, so knowing how to label as impulse and correction will help you know where the market is moving into, and it will also help you know when the trend or the market structure changes, so that you can actually change your bias. All right, so we can denote this as a break in structure. This is where the high here was violated or it was broken, so this becomes the BMS. This is also the BMS. All right, now remember, the market, this is an impulse, and for this to be a correction, it must not go above this. All right, so this gives us an SMS, meaning this level, this 0.2 hasn't gone above this point F. All right, if it has gone above point F, then it would have been an impulse. Okay, since this is a correction, it becomes an SMS. Same thing applies here. Since we have 0.7 having not to go below 0.5, even though it has created a double bottom, it becomes a correction. Now a correction A correction and a correction brings about a shift in market structure. All right, we can have it inclined also here as a shift in market structure. All right, so we should be able to classify those type of movements. So once we're able to, make this classification, it will be way easier for us to know the market direction. All right, trend formation. All right, we will try to talk about trends, and literally we know what trends are. All right, literally when you say music is trending, it means it has been going on for quite some time. So the trend is more like a reoccurrence of an event. All right, so something is trending. Alright, so trending is basically a repeated market structure in a predefined direction, or a continuous market structure or cycle. So talking about market cycle, we're talking about cycle 1, 2, 3, cycle 1, 2, 3. Alright, so once the trend is moving to the upward direction, we can call it a bullish trend or an uptrend. Now when the trend is moving to the downward direction, we can call it a bearish trend or a downtrend. Just like we have bearish structure, or a bearish or a bullish structure, now we can have it as a bearish trend or bullish trend. And now what makes it a trend is this. Now we have A, B, C, D as a bullish market structure. Right, A, B, C, D as a bullish market structure. Now we can actually pick another structure, which is C, D, E, F as another bullish structure. We can pick E, F, G, H as another bullish market structure. So we can say a trend is an overlap market structure in a specific direction. So we have clusters of bullish structures in an upward direction. That gives us an uptrend. Now for the bearish trend, we can have A, B, C, D as a bearish structure. You can see C, D, E, F as another structure. Now E, F, G, H as another structure, that gives us a downtrend. So our retracement, or we can call it a corrective wave, will be our cycle. Okay, we'll denote our cycle by our retracement. So this retracement gives us a cycle 1, another retracement gives us cycle 2, another retracement gives us a cycle 3. Same thing applies there: retracement, cycle 1, retracement, cycle 2, retracement, cycle 3. So that will give us a market cycle. Now this is a rudiment. If we have a bullish trend as A, B, C, D being a structure, now A to B is an impulse, B to C is a correction, C to D is another impulse. Now after this impulse, we are anticipating a what? A retracement or a correction. Now a retracement must come into this circle before you can guarantee that being a retracement. So the minimum level it will get to is between the tip of this circle to the bottom of this circle. Alright, so a retracement should come into this circle. The same thing applies there. For this to be a retracement, it should come into this circle. Alright, so this is a retracement. After an impulsive, we anticipate that the next retracement should come in between this circle, inside this circle. It should not go below this circle, and it must touch at least the tip of this circle. Alright, so the same thing applies there. We have a retracement and we have a circle. Now this next retracement must come into this circle. It must not go above this circle, and it must at least touch the tip of this circle. In correction or retracement, impulse. Now after this impulse, we anticipate a retracement, and this retracement must come into this circle too also. Alright, so if it goes above any of these highs, then there's a tendency for a change in market structure. So this we can say a corrective wave is called a retracement, while an impulsive wave, we can say a retracement plus an extension. Now we can have this as an impulsive wave, A to B. B to C will be called a corrective wave, which is also called a retracement. C to D will be called an impulse, but this time we have a combination of corrective wave plus extension. Now from C to this level will be called a retracement. Now from this level to this level will be called an extension. So therefore we can say C to D is retracement plus extension, which gives us an impulse. Alright, so it's just simple logic. I hope you understand. Alright, this is under random chart showing bearish and bullish trend. Alright, so we say we can visualize that we have a trend moving to the downward direction. over time, and we have this moving to the upward direction over time. So that gives us a bullish trend, that gives us a bearish trend. But how can we tend to label a trend? All right, so first thing is to pick out the highs and lows. All right, so this is the high and this is the low. A high, a low, a high, a low, a high, a low, a high, a low. Right, we can also say this is an impulse, correction, impulse, correction, impulse, correction, impulse, correction, impulse. We have impulse, correction, we have impulse, correction, sorry, we have correction, rather impulse, correction, impulse, correction, impulse. All right, so remember we said if this is going to be a correction, it must not go above this level. So that makes here this level a correction, we have an impulse. If this level is going to be a correction, it must not go above this level. So that makes this a correction, we have impulse. Correction must not go above this, impulse, correction, impulse. Now why we term this impulse is it keeps breaking this low. You know, the low always gets violated and broken. Same thing applies here. For this to be an uptrend or a bullish trend, it must at least keep breaking the previous highs, while the lows don't get broken for the trend to be intact. All right, we can also visualize it in form of circle. So where is our market circle? So we have a circle 1, 2, 3, 4. Now we can say the circle are our retracement, all right, or correction. So impulse, circle of what? Correction, impulse, circle of correction, impulse, circle of correction, impulse, circle of correction, impulse. So you can see that it's moving to downward direction. Now to the upward direction, we have impulse, circle of correction, impulse, circle of correction, impulse, circle of correction, impulse. All right, so we can assign the circle of correction to a corrective wave, right? So we know that the next thing follows from a correction is an impulse. Support and resistance. All right, this I know you might at some point heard of support and resistance a couple of times. Okay, we just want to explain in our own best of understanding so that you can have an added knowledge to what support and resistance are. Now support is we can see a support literally as a floor of a house, while a resistance as a roof of a house. Alright, imagine you have kids playing around the home and they throw a football across the ceiling. Okay, you expect the football to bounce off of the ceiling, alright, or the roof down to the downward direction. The same thing applies if the ball is being bounced to the floor. You expect it to bounce backward to the opposite direction, right? So same thing applies. Resistance are found at the top of the chart, while supports are found at the bottom of the chart. All right, now once the market is moving to the upward direction, we assign that we have buyers. You know, they are buying, the market is being bought. And once the market is moving to the downward direction, we assign that the market is being sold. All right, so we have buy, we have the sell, buy, sell, and buy. All right, but who are the buying and who are the sellers? No, we have buyers and sellers in the game. So the buyers are found at the level of support because they keep buying the market to the upward direction. They buy the market to the upward direction, they buy the market to the upward direction, and they bought the market to the upward direction. While we have the sellers to be the resistance, they keep selling the market to the downward direction. Alright, but because we have more buyers than the seller in an upward trend, then we should see more of support, you know, impulsive move to the upward direction. And the contrary will be for the downward or the downward trend or bearish trend. You can see that the resistance is found at the bottom, while the support is found the resistance is found at the top, while the support is found at the bottom. All right, so we have sellers pushing price downward, the buyers buying a little, sellers pushing with great pressure, little of buying, more of selling. Right, so when it comes to this, we have more of buying, little of selling, more of buying, little of selling, more of buying, little of selling, more of buying. In the downward direction is the contrary. We have more of selling, little of buying, more of selling, little of buying, more of selling, little of buying, and more of selling. Now once the market is moving to the upward direction, you always want to buy, you know, because the trend is moving upward, you always want to be a buyer, and if it's moving to the downward direction, you always want to be a seller. All right, because there's high tendency the market to move way further relative to this movement. This is longer than this. All right, so you rather want to stay in the position of the longest move. All right, so now if you throw a football to the roof and it bounces back, now the reason why it's bouncing back is because not because the roof or the balloon are related or something. And the reason why it's bouncing back is due to the strength. Okay, so if you push a ball to the roof or the ceiling, it will bounce back. All right, because the ceiling is stronger than the football. All right, but if you do the contrary, whereby you throw a rifle, or probably you throw a missile to the roof, all right, you don't expect the missile to bounce back, obviously. All right, because the strength, the speed of the missile is stronger than that of the roof, so you expect it to be broken through. All right, so each time we have a resistance being broken, then you know that we have a lot of pressure to the upward direction relative to the correction here. All right, so the impulse are more like missiles. All right, they are more stronger than the corrective. All right, so each time we see resistance being broken, then we know we have more missile to the upward direction. So in an upward direction, or in an upward trend, we want to see resistance being broken often. So this resistance should be broken, and when the market creates another resistance, it should be broken. When it creates another resistance, it should be broken. In a downward direction, we want to see support being broken. So if it creates a support, we anticipate it to be broken. If it creates another support, we anticipate it to be broken. If it creates another support, we anticipate it to be broken. All right, so these are historical levels. All right, and we can use them to predict further or future market movement. All right, so still on support and resistance now. With respect to the previous example we used, we have impulse, correction, impulse, correction, impulse, correction, and impulse. We have correction, correction, impulse, correction, impulse, correction, impulse, correction, impulse. Now you can see that the market has moved from one end to the other end. All right, from a bullish market, from a bullish trend to a bearish trend. Okay, but you know, trading as a technical trader, we believe in this psychology that the market history repeats itself, meaning if the market has respected the level in the past, there's high tendency that it will respect it later in the future. So we make reference to such areas later in the future. Take for instance, we have point A as a support, point B as a resistance, point C as a support, point D as a resistance. Now this point B rather, if we get to project it later in the future, we'll find out that this will be an historical level where price will tend to relate. So on just this point B, we can see that the market has touched it, or they've had an activities about 1 time, 2 times, 3 times, and the 4th time. Okay, same thing applies. This is the resistance. If you project it to the future, there's high tendency the market will react to it. Okay, so while the market is trending to the upward direction, we can project all the lines to which it is, you know, reacting off of. So if the market has reacted off of this resistance, we plot it out to the nearest future, we trace it out to the nearest future, we trace it out to the nearest future, with the hope that if the market gets there in the nearest future, then it should react from those levels. So this is a support here. The market has changed trend, yet it is respecting those areas of support and resistance. All right, so we said support are found at the bottom of the chart, while resistance are found at the top of the chart. And if the trend is moving to the upward direction, then we should see that the resistance will be broken, and if the trend has changed to the downward direction, then the support areas should be broken. All right, so we want to see how to project those lines so that later in the future we can see price react off of them. So this is another random chart. We want to see where are the support and resistance, and how can we place support and resistance. Now we have the support and resistance being placed, and before you can ascertain that an area is a support or a resistance, you must have at least a high level of reversal, or a pull away, or a correction. All right, so it's not just an area you can just decide to pick. Let's say from this area we have the market move to the downward direction. This is a relative distance. We have another move to this direction before a move to the downward direction again. All right, so this is another support. The market has respected this area first time by bouncing off. It came into that area again, it bounced off of it, so that makes this area a unique area. And the market has broken through this point. It has retraced or corrected itself down here. Now way into this level where it has broken before. Now this becomes a support. This was a resistance, now it's coming to become a support. All right, so the market moved from this level to the upward direction, retraced down a little to the downside, now went, created another impulsive move to the upward direction, creating another another resistance. Now this resistance at this level has turned into a support here. Now the market has broken through this support, it has turned into a resistance. All right, so we have this area as a support, it is also holding as a support. There's this reaction off of that level. Okay, the market has broken through, rallied into that same level. So at this point it was resistance, now it is support, it's switching back to become resistance, and it has moved down price. Now this area has been a support, and also acted as a support here. So off from this level the market has rallied right into this resistance. So those levels are places where market will tend to bounce off of. Bounce from level of support to resistance and the level of support. So there are levels in the market, right? There are areas where the market will tend to react once it gets there. They are logical areas. All right, so this gives us a hint that if we can plot lines from the past, project them into the future, there's a tendency that once the market gets into that area, we can have price react because it has reacted one time in the past. There's a tendency history can repeat itself. All right, so that's the context of support and resistance. We're talking about candlesticks analysis. Now, if you have gone through the beginner the introduction class, we said we'll be making use of candlesticks as a medium of charting. So obviously you must have seen a candlestick chart, and we'll be explaining the anatomy of a candlestick. All right, so a bearish candle is in the financial market means a downward price movement. So if the market is moving downwards, we want to see bearish candles. If the market is moving upward, we want to see the opposite. So in a bearish market, we want to see more of bearish candles. In a bullish market, we want to see more of bullish candles. All right, so what are the distinct features of a candle? Now we can have this body being the body of the candle, and we have this, we can call the tail, or we can just call it the wick. All right, so this denotes the wick or the tail, while the whole of this red denotes the body. All right, so the characteristic of a candle we can have, we should have an open where the market opens at this level and closes at this level. All right, so in between the open and the close we have the high and the low. Okay, so this is just the anatomy. We have open, the market went up high, came down, and it closed. Okay, so there's always an opening price for a commodity, there's always a closing price for a commodity. All right, so the same thing applies here, just that we have a relatively lesser body compared to this, but relative to strength you can say this has more strength compared to this. All right, so the bigger the candle, the bigger the strength and the volume. The lower the candle, the lower the strength and the volume. Now we have the bullish candle. The same thing applies. Anytime we say bullish candle, anytime we're anticipating or we're visualizing a bullish trend or a market structure, we want to see more of green candles to the upward direction. All right, so the same thing applies. We have the body of the candles denoted by this rectangle, while we have the wick here as denoting the open and the close. All right, so the body denotes the strength and the volume, while the wick denotes the rejection. All right, we'll be explaining what that means much later. All right, so you said the larger body connotes strength. So when we are seeing bigger candles, it means that we have bigger volume in the market. That means we have a lot of strength in the market. Now I want to use this analogy when it comes to pricing. Now let's say for instance, in a month, let's say for instance January has how many weeks? 4 weeks. So we'll be using January as a case study for a commodity like an iPhone, or let's assume that an iPhone costs about $100 as an open price. Okay, so let's say the iPhone starts at $100, a big price. So by January it was sold for $100. By second week in January, we got it for $80. It went into $80. By the third week it shot up to about $220, and for the fourth week it came down to $200 before closing. Remember, it has about 4 weeks, right? So it opened at 200, it closed at what? It opened at 100, it closed at 200. Now a lot of participants must have gotten this iPhone for different pricing. Some would have gotten it for 100, another set of people must have gotten it for 80, another must have gotten it for 220, another must have gotten it for 200. Now the difference is the time frame they got it, alright? Meaning they all bought it different week interval, alright? But the value of the phone still remains the same. The phone remains the same, but the pricing differs due to the time frame of purchase. Alright, so now why this candle is green compared to this is because we have the open below and the close above, meaning the value of the iPhone rose from 100 to 200. That means we have a bullish candle. It moves from 100 and it closed at the end of January for 200. That makes it a bullish candle. Now the inverse will be for the red candle, where we have the open at the top and the close will be at the bottom, right? Unlike this, you have the open bottom, close top. For the bearish candle, we have open top, close bottom, but the highs and lows still remains the same. So the same scenario, we have January 4 weeks, and commodity of purchase is an iPhone. So we have the first week, probably the iPhone was sold for 200, and the second week it went up for 220, and the third week it went for $80, and the fourth week it closed for $100. Let's say a lot of participants must have bought the same iPhone for different price during different weeks, right? Weeks interval. Okay, so we can see that the highs and lows here, the high of 200, 220, and the low of 80 is denoted by this week. Same thing applies here. 220, 200 is denoted by this week. Now this denotes how high the price went during the whole of the month. This shows that how low the price went during the whole of the trading month, right? That is January. Alright, so imagine that every month is represented by a candle. Then this will be the candle size for January with these following details. Alright, so this is just the anatomy of the candle, while we have the physical candle here. This is just an illustration of how the candlesticks are being formed. But the larger the size of the candle, the more strength it upholds. So we have the medium sized candle, where we have the body is almost equal to the wick. Alright, so we have the wick relatively equal to the body. Alright, so the same thing applies if you have 4 weeks, and the same rudiment. The market opened at $100, closed at 160, but in between it went as low as 60 and as high as 220, but the market closed as what? A bullish market, because the open is way below the close. So that means the market has gained about $60 profit, or $60 increment. For the bearish market, we can see that is the opposite. The open found at the top while the close at the bottom. The market opened at 160, went as high as 220, dropped as low as 60, and closed at 100. That means the market has lost about $60 worth of value. So it's more like we are assigning the commodity to be like an iPhone, or something you can actually visualize that is physical. Okay, now we have the small body or even no body at all. We have this to show rejection. Alright, so the body is relatively small, smaller than the wick. So the wick here shows a lot of rejection. Same thing applies here. The week show a lot of rejection. So same thing applies. 4 weeks, the market opened at $100. Okay, $100 went as low as $60, shot up as high as $20, and closed at 120. Now you can see that the difference is just $20 worth of value increased. Now the thing is, we should be able to examine that we have a lot of, as when the price came to 60, we can see that we have a lot of rally to the upward direction. Though this rally above away from this area is called a rejection, and the rejection is denoted by this wick here. So these lines above or below the candle suggest a rejection. So now we can say that if the wicks are the same, that means the buyers and the sellers have equal value, or probably we can say they have equal magnitude to pushing price in a particular direction. Okay, so they have equal magnitude because the wick here is equal to the wick here. Same thing applies for the bearish candle. We have the market open at 100, went as high as 220, came down as low as 60, and closed at 80. All right, for that month we can say that price only lost value of about $20. All right, so it's relatively small, but we had a whole lot of reaction going through that whole month, but the difference in value was just little. All right, so we have to pick out candlesticks and with this information we can predict or assign predict what the market is doing, or what is probably going to do coming nearest future. Alright, this is a random chart. We want to see what are those information the candlesticks are actually putting across to us. Alright, so the smaller body denotes low volume, while the larger body denotes high volume. Alright, so we have these clusters of candles which are have low bodies, small bodies as low volume. You can see this is relatively large candle, that is a high volume, a high volume candle, and a high volume candle, while all of these are low volume candles. All right, so you should be able to visualize these candles with your bare eyes, and being able to do that will help you suggest what potential areas the market might tend to move into. All right, now we'll be talking in terms of pressure. Now looking at this chart, we can see that we've highlighted series of candlesticks pattern moving in the same direction. All right, so we have clusters of red candles, which is a seller candles, moving in the downward direction. Compared to these little candles, you can see that this has more pressure to the downside, so that is a huge selling pressure. All right, so you can see that even though the market has rallied to the upward direction, you can see that the green candles are not as huge as these red candles. All right, you can see another series of red candles which are huge. So this denotes a huge selling pressure, meaning we have sellers in the game, okay, in the market. So you can see that we have sellers pressure, we have sellers pressure. Buying pressure, we can see that during this time frame, you can see that the market has brought about just a few selling. All right, we have few selling candles, but now you can see that we have more green candles to the upward direction, increasing in sizes. That means we have buying pressure. There's high tendency the market keeps going upward, so we can identify that now we think buyers are into the game. Prior to that time, we can see that we have just relatively low candles, all right, with small bodies. And after this last candle, you can see that the body of the candle begins to increase. So we have a pressure here from the buying. 4 green candles moving in the same direction with relatively medium shape, and we have clusters of small candles before this huge buying pressure candle. So you can be able, once we look at our chart, we should be able to identify where are the buyers or where are the sellers, or where are the trade mark they've set on the chart. All right, so you must have seen their footprint on the chart by the pressure being exerted. All right, so that brings us to the end of this webinar. I hope you've learned something, and if you have, please give us a thumbs up, comment, and give us a feedback. We love your feedback. It encourages us, and it helps us to know what more we should do and how we can adjust to serving you much better. It shows that you're actually having or getting value to all of this, and will in turn encourage us so much. Thank you so much for all the support, and if you have much question, please let us know. Check on our telegram channel. We giving analysis and all of that together. So thank you, and I believe this has gone a long way to impact a little into you. So please follow us, subscribe on our channels as we bring more videos of value to you. Thank you so much, and please do have a lovely day ahead of you. Bye.